Hello everyone, welcome back. So a lot of people get into real estate because they think it's the cheat code to never paying taxes again. I'm sure if you spend some time perusing the interwebs, you'll hear stories about investors with huge portfolios who somehow pay next to nothing to the IRS. And naturally the thought is, well, if they can do it, so can I. But here's the thing, it's not automatic. You don't just buy a rental property and magically wipe out your tax bill. You need to understand how the tax code treats rental income and which strategies are actually available to you. And I get it, taxes may not be the most exciting thing in the world, but having a basic understanding of how the real estate tax code works can save you tens of thousands in taxes, and that is exciting. So in today's video, I'm going to cover a few different ways you can legally lower your taxes with rental real estate. First, I'll break down the $25,000 passive loss allowance and other adjacent strategies. Next, we'll go into the short-term rental loophole, which is becoming a very popular strategy. And finally, I'll talk about real estate professional status, which allows for tax benefits that only people in the real estate industry can qualify for. Now, before we dive in, as is tradition, here's my quick disclaimer. This is for educational purposes only. I'm not your tax advisor, and this is not tax advice. All right, let's start with the $25,000 passive loss allowance. Normally, rental real estate is considered a passive activity, and under IRS rules, passive losses can only offset passive income. So if you have $10,000 in rental losses and no other passive income, you usually can't use those losses to reduce your income from your day job. But the tax code has a special carve-out just for small investors. If your modified adjusted gross income, also known as MAGI, is under $100,000, the IRS lets you deduct up to $25,000 of rental losses against your ordinary income. This benefit begins to phase out at $100,000 until you hit $150K in MAGI, at which point $0 in losses can be used to offset your active income. So what exactly is MAGI in this context? Well, it starts with your adjusted gross income, or AGI, and you have to add a few things back to your AGI. That includes any passive losses you claimed and things like IRA contributions. So if you thought you were under the $100,000 threshold based on AGI, adding those items back in could push you over the line where the benefits begin to phase out. Now, just because you have a rental and are making under $150,000 doesn't mean you automatically qualify for this deduction. You have to own at least 10% of the property and actively participate in the management of your rental, which is actually pretty easy to achieve, at least in comparison to material participation, which we'll be covering in the next two sections. So according to the IRS, management decisions that count as active participation include approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. Now, as I mentioned earlier, this benefit starts phasing out once your MAGI goes over $100,000. For every $2 of income above that threshold, you lose $1 of the allowance. And by the time you hit $150,000 of MAGI, the allowance is completely gone. So for example, if your MAGI is $120,000, you'd only be able to claim about $15,000 max. So what if you make over $150K or don't have a lot of time to participate in the management of your rentals? Well, tax credits from certain real estate investments like historic rehabs or low-income housing can offset your other income by up to $25,000 as well, even if you don't actively participate. For historic rehab credits, these start phasing out when income hits $200,000, not $100,000 like the passive loss allowance. Now, once your income passes $250,000, the benefit to your active income disappears entirely. One thing to note though is that low-income housing credits don't have an income phase out. So for people in higher tax brackets, these can be invaluable. Now, here's where most people get tripped up. The $25,000 limit applies to the total of both deductions and credits. It's not $25K in deductions plus another $25K in credits. The IRS doesn't let you get that lucky. If your combined deductions and credits go over $25,000, you have to use the deductions first and then convert the remaining credits into deductions for that year. But that's getting pretty deep into the weeds, and I can already feel my viewer retention dropping for this video. Now, let's talk about the short-term rental loophole. Properties where the average stay is 7 days or less are treated differently than your typical rental. The IRS doesn't automatically consider them rental activities, and that opens the door for some major tax advantages. But here's the catch. You have to materially participate. That's the IRS's way of making sure you're not just an absentee owner collecting Airbnb checks. Now, we talked about active participation for the $25,000 passive loss allowance, but material participation participation is a more rigorous standard than active participation. Material participation basically means you're regularly and substantially involved in the operation of the rental. There are 7 different tests for it, and you only have to pass one of them, but the most common ones are: 1, your participation is substantially all of the participation, meaning you're basically the one doing all the work, or you put in more than 100 hours into the short-term rental per year and no one else participates more than you, or you participate for more than 500 hours during the year, regardless of if someone else participates more than you. So if you're managing the bookings, communicating with guests, and handling turnovers, that all can count towards those hours. And the cool thing about the short-term rental loophole is that you're not capped on up to $25,000 in deductions per year, as is the case with the passive loss allowance. Finally, let's cover real estate professional status, or REPS. I have a more in-depth video on this topic here, but basically REPS enables you to utilize depreciation from your rentals to offset other income, no matter your income level. To qualify, either you or your spouse needs to spend more than 750 hours per year in real estate activities or businesses, such as being a real estate agent or property manager. And more than half of the real estate professionals' total working time has to be in real estate. In addition, you have to own at least 5% of the real estate business. And finally, you must materially, not just actively, participate in the management of your rentals. When you qualify for REPS, rental real estate is no longer automatically considered passive. That unlocks the ability to use rental losses against your ordinary income. So we're not just talking about a max of $25,000 anymore, we're talking about potentially tens to hundreds of thousands in depreciation offsetting your income. For high earners, this can be the difference between paying 6 figures in taxes or keeping that money to reinvest. So to wrap this up, the $25,000 passive loss allowance for rental properties is great if your MAGI is under $100,000, but it phases out to 0 as your income grows to $150,000. The short-term rental loophole lets you use losses even if your income is over $150,000, as long as you meet the average stay requirements of less than 7 days and materially participate. And finally, if you or your spouse qualify for real estate professional status, you can utilize your long-term rental losses to offset your active income, as long as the spouse that qualifies for REPS materially participates in the management of the rentals. Alright, if you found this video helpful, make sure to hit that subscribe button so you don't miss the next one. Thanks for watching, and I'll see you next time.